Broadcom, ticker AVGO, is a powerhouse. It's the backbone of AI networking and custom chips. But today, I'm not here to talk about the hype. I'm here to talk about my bear thesis for 2026. Now, you might be wondering, if you have a bear thesis, why are you selling puts? Usually, selling a put is a bullish move. But in my strategy, I use a bear thesis to build a margin of safety. I'm not trying to guess if the stock goes up. I'm positioning myself so that even if the stock struggles, I still win. Today, I'll break down the 2026 bear case, the institutional support from giants like BlackRock and Vanguard, and the exact trade I just entered to collect over $2,000 in premium. Let's look at the risks. By 2026, the AI honeymoon phase will likely be over. We're looking at three major headwinds for AVGO: AI spending fatigue. Hyperscalers like Google and Meta are spending billions now. By 2026, they'll be looking for a return on investment. If that ROI slows down, so does the order book for Broadcom's ASICs. Valuation. Normalization. AVGO has traded at a massive premium. If growth slows even slightly, a PE compression could easily drop the stock by 20-30%. Cyclical cooling. The semiconductor industry is famously cyclical. After a multi-year boom, 2026 could be the year the cycle turns. The price projection. If the bear case hits, I'm projecting a potential floor in the $280–300 range. This represents a significant pullback from current levels, but it's a realistic worst-case scenario I'm planning for. Because I anticipate this potential 2026 weakness, I didn't buy the stock at today's price. Instead, I sold the December 2026 put with a strike price of $265. Strike price, $265. This is 15% below my projected bear floor of $280. Premium collected, $2,070 per contract. Why this works? Even if my bear thesis is right and the stock drops to $280, my contract expires worthless, and I keep the $2,070. I only lose or get a sign if the stock crashes below $265. By using a bear thesis to pick my entry, I've created a massive cushion. I'm essentially saying, I think the stock might drop, so I'll only agree to buy it if it drops way more than I even expect. But I don't just sell puts on any stock. I have a strict second condition: institutional backbone. I require that the world's most powerful funds, BlackRock and Vanguard, own at least 15% of the company. Why? Because they provide sticky liquidity. They don't panic sell, they rebalance. Currently, Vanguard owns about 10.2% and BlackRock owns roughly 8%. Together, they hold over 18% of all AVGO shares. Knowing that $130+ billion of the company is held by these anchor investors gives me the confidence that the stock won't just vanish to zero. It's a floor built on institutional gold. This is how I use cash-secured puts on big and powerful companies to reach my financial goals earlier. Instead of fighting the market, I'm collecting rent. If AVGO stays flat or goes up, I keep the $2,070. If it hits my bear target, I keep the $2,070. And if it crashes past my safety zone, I get to own one of the best companies in the world at a price most people can only dream of. That's the power of selling puts with a margin of safety. If you want to see more of my actual trade logs, let me know in the comments. Don't forget to like and subscribe for more deep dives into my portfolio. See you next time.